We're taking a look at the currency market now with Michael Keenan, head of Forex Research at Standard Bank. Thanks so much, Michael, for joining us this morning. And just as you get back from Europe, so take us through what you've been exposed to over on that end and the kind of sentiment that's filtering through on the ground over in the Eurozone territories.
Good morning, Alishia. Well, clearly the Europeans indicated that there's obviously been this liquidity squeeze within the region, within the sort of the peripheral areas of Europe, and there was undoubtedly a bit of a run from that contingent on the South African bonds, the equity markets. They needed cash, so they liquidated some of those positions. But the more longer-term players have still got a fairly constructive view on South Africa. They still like the kind of yield and the coupon pickup that we've seen from the South African bond market, and as such are probably looking for entry points again to come back into the market. They're not too concerned about the South African fundamental backdrop, and of course they're encouraged to see that South Africa's got fairly limited exposure to that sovereign risk out of Europe. I think one of the big issues that came to the table was that of China. People are becoming increasingly concerned about the Chinese story, and so too am I. I think that that is probably the biggest risk now facing South Africa and emerging markets.
Yep, well, let's take a look at that story because, of course, we've seen, we were chatting about just ahead of the break, the data filtered through from China yesterday, that trade number, many saying giving the Chinese some ammunition at least as it progresses into this battle with the US.
Yeah, I think at the epicenter of the Chinese problem is what's happening on the property front, really. And the property front is related to that trade dynamic because a lot of the properties and factories that have been built in the anticipation of strong demand for Chinese exports. The problem is, as you say, now we're kind of having the slowdown in Europe and the States, and there's a lot of kind of empty cities, a lot of empty factories in China. And we've seen property prices in China growing by 32% on the year. A lot of the bad defaults that are starting to come through now in the Chinese property market are being kind of hidden in these kind of basket instruments. So, the fear is that we're going down the exact same road as we did in the States when we had all those subprime mortgages where things were kind of hidden under the carpet up until the very end when things all turned pear-shaped. So I think we've got to watch what's happening in the property space in China, and of course linked to that is ultimately the demand that we're going to see from the Western countries. But I'm actually quite nervous about China. I'm not very constructive on it at all.
What do you see that context that you've just highlighted spelling for monetary policy moving forward over in China?
Yeah, they're in a very difficult situation because they obviously want to try and restrict any more sort of bad loans and the so-called shadow banking that's taking place. They want to kind of limit that exposure, but at the same time, they can't really afford to tighten monetary policy too aggressively because they want to try and shift the focus of the Chinese economy away from all this infrastructure and export orientated into the consumer side of things. So you can't be too tight on that side. So I think at the end of the day, we're probably going to see more reserve requirements being lifted. I don't think we're going to see any more rate hikes at this stage.
Well, talking about the consumer on that end, there's still very much of a spotlight cast on the US consumer as well, and what that, the health of that consumer is going to spell for its economic growth moving forward. We're anticipating retail sales numbers out of the US and consumer confidence numbers as well. Your expectations on those fronts, Michael?
Yeah, well, we don't specifically forecast the US retail sales, but I mean, if we look at the market consensus, they are expecting an improvement. Remember, last month there was basically no growth on the, on a month-to-month basis, and we need the US consumer ultimately to come back to the party. He really is the consumer of last resort. I don't believe that China is the consumer of last resort. We're still going to take a long time before Chinese wealth creation really takes root there. So we need to see the world's largest economy economy kicking off again, and the biggest component of that economy is, of course, the US consumer. So that's going to be key, I think, for sentiment going forward. We saw some encouraging payrolls figures yesterday, at least last week, out of the States.
Yeah.
Let's hope the trend continues. We've had some iffy-butty kind of retail earnings figures out of the States this week. So we're clearly not out of the woods yet. And as I say, I still think we're in kind of a risk-off environment, still like buying dollar dips medium term.